In this segment, we are going to look at the use of the weighted average method to account for inventory costs. The weighted average method assumes that the cost of inventory is sold at the current average cost of all inventory that is on hand at the time of the sale. So using the same cost information we have been using previously for the other methods, we're starting off with 10 units of inventory at a cost of $91 a piece, beginning inventory of 9/10. During the month of August, 3 separate purchases of inventory are made, and we had 2 separate sales of inventory, 20 units at a price of $130 and 23 units at a price of $150. So when we are going to apply the weighted average method, we need to understand how to assign or calculate an average cost of the units of inventory on hand at the time the sale is made. In order to calculate the average, we are going to take the total dollar amount or the total cost of the goods that are available for sale at the time the sale is made and divide by the number of units in inventory at the time that the sale is made. So applying that, we're starting with 10 units at $91 a piece in the beginning of August. On August 3rd, 15 units were purchased at a cost of $106, bringing the total cost of inventory available for sale up to $2,500 and the number of units available for sale at 25. The 10 units that they started with plus the 15 they just purchased. On August 14th, 20 units were sold. In order to figure out what cost we are going to assign to those units sold, we need to know what the average cost is of the units in inventory at the time of the sale. So at the time of the sale, $2,500 of goods were available for sale, and that was made up of 25 units of inventory. So if we take the 2,500 and divide by 25 units, the average cost of each unit in inventory at the time of the sale is $100 per unit. So we are going to assign a cost of $100 per unit to the 20 units sold on August 14th. The cost of goods sold will be $2,000. That will leave $500 of inventory available for sale on hand, which is the 5 units remaining, 25 available, 20 were sold, at an average cost of $100 a piece. The trick is with the weighted average method, every time a sale is made, we have to calculate a new average, and that average changes after every purchase. So if we start the 17th of August with 500 units of inventory on hand, and we purchased another 20, we added $2,300 of inventory, bringing the inventory available for sale up to $2,800. We then made another purchase on the 28th, adding another $1,190 to our inventory, bringing the inventory available for sale up to $3,990. When we sold 23 units on August 31st, we need to determine what the average cost is at that time that sale was made. So to determine the average cost, we need to take the total dollar amount or the total cost of inventory available for sale and divide by the number of units available. We had 5 units. We added another 30. So we had 35 units available for sale. The total cost of $39.90 divided by the 35 units means the average cost of each unit on hand is $114. So the cost that will be assigned will be the $114 average cost times the 23 units sold, or a cost of $2,622. That will leave us with $1,368 on hand, which is the 12 units that are remaining at an average cost of $114 or $1,368. The total cost of goods sold that will be reported for the month will be $4,622 under the weighted average method. The inventory reported on the balance sheet will be the $1,368 remaining. Again, the journal entries under the weighted average method are no different than the journal entries under any of the other methods, specific identification, FIFO, or LIFO. The only difference is the amount that is recorded in the cost of goods sold entries. Under the weighted average method, the cost of goods sold will be $2,000 on August 14th and $2,622 on August 31st.